Of YouTube, this is the Working Investor. In this video, we're going to go ahead and compare a bunch of different funds. So we're going to compare funds that I want to look into, where I wanted to divest out at the time for having uncorrelated assets. Like I mentioned in my previous videos, that my plan is to find funds that have uncapped upside, because all the cover call ETFs, by definition of cover call, synthetic cover call, is that you have a capped upside. So I need some funds that have uncapped upside when the market goes up. I also need funds that are uncorrelated to the market. So let's get into the video. So first of all, I kind of made this post earlier. This is the 1-year chart of QQQY versus QQQ versus QDTE. Now, when I look at a fund, I look at the fundamentals, the underlying, and I look at the option strategy, especially if it's an option-based ETF. If you're investing in option-based funds, and everything here is not financial advice, legal advice, tax advice, or any other advice, but I do recommend strongly that if you're investing in something, you should research what you invest in. That's common wisdom. And QQQY, they do pretty much in the money puts. So it's a type of option strategy where they sell in the money puts. That means that they need the market to go up. They're already starting off with a left foot and they need the market to go up. Otherwise, they're going to be in a loss. So this is horrible in a downward cycle, and it's going to really exponentiate the losses. So here you can see the 1-year chart, and I like to compare total return to total return, because you want to add the price and you want to add the dividends, and you want to get the full picture. So this is from Seeking Alpha, and I like to get as much data as possible. So I think QDTE came out about a year ago, so that's why I'm doing the 1-year chart. If I had more data, I would do more. You can see here that QQQY pretty much is in the toilet. The total return, even after you account for all the dividends, is 1.86%. That's far inferior to pretty much having your money in a treasury product or in a high yield savings account. And something very important to bear in mind is breaking even is actually losing money. We're not investing money into the market and having market risk to break even. And when you break even, you're actually losing money. I say that because breaking even, you have to pay taxes on it. So the tax implication will erode those little 1.86% measly gains. And then let's also talk about inflation. That will also eat away in the buying power. So that was just a losing situation. If you had the Qs, according to the total return, because there's probably a little dividends in the Qs, you get 11.06%, even considering the down market we just had right now. And QDTE would have beaten the Qs, and I'm not surprised. So QDTE is basically a zero day to expiration cover call strategy, or should I say synthetic cover call strategy. And this is by Roundhill. Again, I'm not advertising Roundhill. There are other players in the market. Just giving it an example. So they write every single day with overnight exposure to the upside or downside, synthetic cover calls. And basically, if the market is flat or the market goes down, hypothetically, this theory, you should outperform. Theoretically, why should you outperform if the market's down or the market's flat? Because they should correlate close to what the market does, right? So if it goes down, it would go down as well. It would go down with the underlying would go down as well. The only difference is the underlying doesn't derive income every single day from the zero day to expiration cover calls. So because it's deriving income every single day from the cover calls, in a flat market, it would pretty much replicate the market plus the difference of the income. In a down market, it would replicate the downward momentum, but it would also have that income. But in an up market, it may underperform in an up market. But the good thing with zero day to expiration options is that you can pretty much adjust it. It gets adjusted every single day. So if one day they have a losing trade, doesn't necessarily mean the next day they may have a losing trade. So this is just an example of these 3 funds. So think about the underlying, I think about the strategy, and I think about the pros and cons of the underlying, think about the pros and cons of the strategy and the market conditions. So like I said, you have here in the money put, so you need the market to go up, otherwise it's losing. You have just the NASDAQ, and then you have the NASDAQ with, overnight exposure, zero day to expiration, calls, pretty much. Here I have an analysis between XPAY, S&P 500, and XDTE and XPAY, and you could see that XPAY actually outperformed the S&P 500. I started this from October 31st, 2024, because that's when XPAY, around that ballpark window, that's when they launched, around that time. So that's the most data I could collect. Actually, if people who own the S&P 500 will usually own it through a ticker symbol VOO, it's more cost effective. So let me just try that for a second. So you could see with VOO, which is also exposure to the S&P 500, a lot of people like to choose this one because it has a lower expense ratio. It's more capital efficient. You could see actually it did outperform XPAY. XPAY 1.25%, VOO S&P 500 more optimal, 1.63%. So it outperformed, and then XDTE underperformed. T-SPY underperformed a little bit compared to these assets. It's surprising because XPAY, they came out with an article. I mean, a lot of investors have this. It's in the email list. Basically, they try to compare and contrast XPAY to XDTE, but theoretically, XPAY basically they're buying deep in the money, very very deep in the money, like a 1 delta call, and then they're cannibalizing very very slowly the fund over a period, about 20%, exactly 20% per year. So basically, if you do the math, 20% per year, so divided by 12 months. So if the market is down, if the market's flat, then every single month you're losing 1.66%, because 20 divided by 12 is 1.66%. So if there's a month where the market's up 1.66%, theoretically, when you get the dividend, you should fully recover the time the next month comes, because the market went up 1.66% to compensate for the dividend that they gave you. But the dividend is not being generated. There's no income generation for this dividend. They're just they're cannibalizing the fund. They're taking the fund you have and just giving you back your own money. You could also do it yourself by, let's say, if you buy VOO and then you divide it by one, you just take 1.66% and you sell it. The only difference is that, you don't want to get short-term capital gains just in case if the market's up, or, they have it like more tax efficient with return on capital. Again, not an advisor here, and they're charging you an expense ratio for this. So it's not actually deriving any income. And there is people like it because they feel like it's NAV stable, because, your NAV is, the volatility is based on the S&P 500. And the months that the market's up, you're going to theoretically recover from the dividends because the market went up more than 1.66%. But the problem is when the market's down, there's something called sequence of return. So here's an article from Charles Schwab that talks about sequence of return. And basically, it's just a fancy way of saying that if you're selling something on a timed schedule, something that's in the market that fluctuates up and down, you may be selling, like you don't want to sell. A person would likely not want to sell when the market's down, because then you're selling for a loss. I would prefer to sell when the market's up, because then you're selling and taking some profits off. But when someone is on a scheduled payment and they're cannibalizing their funds, let's say if someone's already in retirement and they want to take a little bit of their funds and start selling it to cover their bills, if they're on a scheduled payment, like by selling some of their funds, they could be selling when the market is down, and they have sequence of return risk. So how do you mitigate this, right? I was thinking of a creative idea. Right now I'm not invested in XPAY, but I was thinking if I were to be in XPAY, maybe the months that the markets are down, when I get my 1.66% dividend payment, which is just a piece that they sold, those months, maybe I won't use those dividends. Maybe I'll reinvest them right away back in. So when it's sold for a loss, I buy them right back in for around the same price. So this way I'm kind of controlling when I will take the dividends. And maybe the months that the markets are up, maybe those months I'll allow myself to take the dividends and use them however I seem fit. So that could be something that I'm thinking about if I were to be an XPAY holder, possibly something I could do to mitigate the sequence of return risk. Also, in this chart, we're doing a very short-term horizon. I mean, if you look back, let's say if you go to T-SPY, and T-SPY has been around, I think, since, let me see, August 15th. So basically the longer time you have, the better you could get an idea of when you're comparing funds. Because the more time, the more, you know what I mean? Because you want to see how they do in all kinds of market conditions as a sum. So let's put in August 15th. So we'll go to September, August 15th. Let's see what happens here. So, oh, I have to update this. Yeah. I mean, it's not going to be accurate for XPAY because they weren't even around then. But I'm just looking at VOO. You know, you could see here VOO, then you know SP 500, and then you could see here XDTE outperformed the S&P 500, and T-SPY, well, I guess they didn't. I guess I have to look into this again. But the point is that the more time you have to compare, the better idea you have, the better sample size you have. So the best is like to have two funds that are like 5 or 10 years. They've been around for 5 to 10 years, and you can really compare them through all kinds of, you know, different market cycles. So I mentioned uncorrelated assets. So one of them is called CLOZ. I opened up a tiny little position in there, and you see they came out January 24th, 2023. So my idea is to find some uncorrelated assets, but they give a distribution income. But also I want to see another metric. I want to see is they kind of at least give me somewhat of return historically closer to the S&P 500. At least I'm not sacrificing market gains relative to the market. So let's take a look over here. So I'm going to take the chart. I'm going to go to January 24th, 2023. So 2023, January 24th. And we're going to compare right now O Realty, because I was looking into real estate. But, if you're going to see that in the past 1 year they outperformed. But if the bigger picture analysis shows that O Realty, which is a REIT, real estate investment trust, I was looking at as an alternative asset, they're down actually, since 2023. In total return, we're looking at total return. S&P 500 42.86. SPY, again, I should probably look at VOO. BIZD, which is a business development company. ETF, so it's a fund of funds. They're 37.19. At least they're kind of in the ballpark of the S&P 500. And CLOZ 29%, still under, total return underperformed, but still at least somewhat, at least closer. You know what I mean? Let's look at S&P 500 and BIZD on the 5-year chart because they've been around for quite some time. So I even changed it to VOO, which seemed, more efficient in a way. Just my opinion. So you could see in the 5-year chart, BIZD, you have a 108.68% in total return, including the dividends, VOO 127. So of course they do lag, but at least they gave you some decent return. It's not just stagnant or I don't want a fund that's uncorrelated to the market. I mean, in a way, it's good for uncorrelated funds are cool. But I also want performance. I don't want them to suck down and drag my portfolio too much. I want them to still give me some, at least have proven to give me some upside potential as well as some distributions. At least I sort of compete. I'll take a lower performing than the S&P, but at least it's somewhere in the ballpark-ish. You know what I mean? But something that's like extremely far out of whack, or negative return, I'll just pass on that. That's just my 2 cents. Anyways, I hope you guys enjoy and have a wonderful trading week. This is The Working Investor, over and out.